Hello, my name is Josh Lipton, and this is my quick thoughts. Today I will be discussing Prologis. So Prologis is a REIT, real estate investment trust. It's a type of investment holding that owns and operates property, real estate typically, and that's how they make money is by operating the property. So I want to discuss this through my framework and how not everything fits into my framework. So Prologis was actually a core part of my holding. I more than doubled my money in this. I bought, I think my average cost basis was around 70, had some dividends, and it's currently up to 144. It's had a very good run in the last month or so. It's up another 14%, and it had a good day today. But after evaluating it, I actually sold out of my position completely. And I want to discuss why that is. And so disclosure, I was a shareholder, but I no longer am, but I still am a huge fan of the company. So let's discuss. So what is Prologis? They own warehouses. So they are part of you can see here, it's a company that invests in logistics facilities. So that's really warehouses. So if you remember my framework, it's product, tailwinds or macro environment, and then valuation. So product. Typically, I like to invest in companies I understand or use. Now, I am not in logistics, so that is a point against it in some ways, but at the same time, I do deeply understand this industry because really what warehousing and logistics is about, I don't deeply understand it, but it's about, I understand e-commerce. And e-commerce, a big part of that is the logistics and warehousing. So I previously had a small e-commerce company, so I understand the difficulties of getting product to people and turnaround times. And Prologis, their main value add is, it used to be that a warehouse, they typically delivered products to, a big a distributing facility, a Walmart or something like that. So you go from a factory to a warehouse to a Walmart. Because of that, you could just account for the lead time. And so warehouses, you want them big and you wanted them in the middle of nowhere because you're shipping it to a Walmart. And so it doesn't really matter. You just get 2 days lead time. Today, with e-commerce, more and more things are being shipped directly to people and their houses. And when you're not shipping a huge truck to a Walmart, instead you're shipping lots of little trucks all over the city, you need your distribution centers to be much more central. And warehousing is a huge part of the economy that we don't even see and understand. And many people are starting to understand a little more as there's lately been a supply chain issues with things getting delayed and container ships coming from China and all this stuff. And it really has made people understand the importance of warehousing and logistics, or maybe just distribution better. And I do think these are tailwinds also for Prologis. The fact that there's a growth in e-commerce, which is a huge part of this. That's the main reason I invested. But we'll get to that. So that's the value of Prologis. They own centrally located warehouses. So, in downtown LA or, in metro centers that are very, and I work in the real estate industry. So they always say, what's the most important thing? Location, location, location. So they have very key location where they're not making lots of new real estate there. It's in farmland. You could maybe build a new distribution center right across the street, but these are in densely populated areas. It's hard to compete. So that is a moat. Warren Buffett talks about moats. It's something that's hard for competitors to repeat or to steal from you. So it's a defensible business strategy. So that is a defensible business strategy they have. So that's the product. They offer warehousing, and I understand that due to my experience with e-commerce. So how about tailwinds? So again, this is a huge thing on the back of e-commerce. It's a strategy called the picks and shovels. Now, in the gold rush, people who did the best were ones that struck gold. But most people didn't strike gold. I think it was over 90% of people didn't find gold. Now, 10% people, they lucked out, they made millions. But 90% made almost nothing. But the people that made a lot of money? The people that showed the picks and axes to all the people trying to find gold. Those people did very well for themselves. So that's a strategy called pick and axe. It's when there's a growing environment, a growing sector, don't try to pick the company that's going to win. Pick the company that's going to support them. In fact, I believe that's what Amazon is. Most of their profits are, maybe there'll be another video, but most of Amazon's profits are AWS, which is Amazon Web Services. That is the cloud hosting. That is, there's lots of online businesses that are going to fail, but if you can invest in the company that's supporting them by giving them server infrastructure, that's going to be a good play. So that's the same thing. This is the infrastructure for e-commerce. This enables e-commerce to grow more rapidly because they're giving better warehousing options to smaller businesses and large businesses alike. And again, with the supply chain issue, we now understand that things, it's difficult to get things from one side of the country to the other when there's a delay here or there. I think early in the year there was a container ship that blocked the Suez Canal. So, there's chinks in the armor, and that could have long-lasting effects on the supply chain. So I do think that this is a tailwind. People are going to bring more and more of their warehousing closer to cities, which will benefit companies like Prologis. So we now understand a bit about what the company does, what their offering is, the product. It's clearly a great product. Warehousing, it's necessary. The value is understood to e-commerce. Everyone likes 2-day shipping. You want your stuff quickly. And we understand the tailwinds behind e-commerce, and understanding that this is an infrastructure play. This is what supports part of the e-commerce play. So now let's understand the business. That's the last part, is valuation. So typically I do this quick analysis, which is I look at the revenue, the market cap, and then what is the growth and the margin. So we can do that, but there are a couple industries that it doesn't work as well for. One of those is REITs, so real estate companies. The other one is financial. So whenever you are experiencing one of those, don't always trust the quick analysis, because there are nuances with those kinds of companies. So for finance, you want price to book value instead of like a price to earnings. And for REITs, you look at what's called price to funds from operations. So if we look at their revenue last year was 4.6 billion, and their growth's been 7, 18, 33, and that was, I think, COVID related, but still, and then 10. So probably averaging about 15%. So, we could say in the future they're maybe going to grow a little slower, but strong growth, especially for a real estate company, not like software where you can have huge growth. Okay, what are their margins? So their gross margins and their operating margins. Like I said, there's some funky stuff here going on with REITs, which is why it's not always best. You can see they had negative margins and huge jumps in gross. Suddenly their operating profit was more than their gross. That doesn't seem to make any sense. And again, a big part of this has to do with the way you account for profits. So I'll show you here. Here's your revenue. Here's your cost of goods sold. So here's your gross profit. So the cost of goods sold is like to produce the manufacturing of it. But there's a thing called EBITDA, which is earnings before interest, tax, and depreciation. So here you'll see it. You can see most companies, their EBITDA is close to their income. Here with real estate companies, it's not, because of that taxes, depreciation, amortization. With a piece of property, you have to depreciate it. So if you buy it for $1 million, you say, hey, every year over the next 30 years, you're going to lose a certain amount because eventually the building's going to collapse. That's basically what you do. So you have to discount your income by the amount that you depreciate. Now, this is a non-cash expense. This is accounting, so it's going to sound boring, but again, not everything about investing is always interesting. It's not like, oh, just invest in some crypto. I actually do own crypto, so I'm not knocking crypto, but there's lots of shit coins out there. Not everything you just watch a YouTube listener and it's a win. Real good investing is research. And so I do like the research. It can be boring sometimes, but this is what you got to do if you really want to make great returns. So there's a non-cash expense, depreciation, but it counts against your income, which is why you'll see REITs often have very high PEs, price to earnings, because their earnings seem low. But it's because of this accounting practice, not because they're actually not making lots of money. So that's why you want to look at what's called funds from operation. So to look at that, if you ever go Prologis and then you go investor relations, you'll be able to see their investment. I already have it open here. So this is their Prologis supplemental information. This is for the third quarter of 2021, which was recent. I find these, you can go through the actual documents with all the numbers, but it's a little boring even for me. I do it, but I like these presentations because they give the numbers on a higher level. So you can see here a bunch of things, but what we're looking here is FFO, funds from operations. Here's core funds from operations. So you can see here over quarter how much they made. I wrote those numbers down here. Oops. So I did an analysis here, which was price to funds from operation, which is a better way to analyze it than price to earnings. So, here was Q3, 795. When we add up the last 4 quarters, we get 3035. So that's the last 4 quarters. So that's your funds from operations over the last 4 quarters. We can also do, projected what the next one is and what that fund from operation is. Here, this is fund from operation per share. You might even see that here. Let's see, per share. Oh, something's going on there. But yeah, so you always want to make sure you're just dividing the right thing by the right thing. So this is your funds from operations. This is funds from operations per share. And so what I did is I basically looked at that and compared it to the market cap during the last presentation. So we have presentations from 2017, 2018, 2019, 2021, Q3 2021, and projected full year 2021. So I took those and compared the market cap, which again is the total value of the company if you buy the whole company, from the funds from operation, which is again a better metric when looking at REITs, per share. So you could also do the total. You could do, sorry, this is the price of the stock. You could do the market cap divided by the funds from operation, but I did the price of the stock divided by the FFO per share. So what we see here is this is price to FFO per share. And we can see in 2017 it was 18. In 2018 it was 19.8, so going up a little. Then it was 21, then it was 26, and then it was 36. So what is this saying? This is saying it's getting more expensive per dollar of earnings. Funds from operations are really earnings. So at 18 and 19 and 20 and 21, I think it's a very reasonably priced company. Even at 26, it's a great company. It's got huge moats. I think that they have, with low interest rates, they can borrow more, and I think they have great management. But at 36, this is getting very expensive. So for me, I still think this is a great company, but when I looked at it, I thought it seemed very expensive. And again, I'll do the gut check again. You know, if you say it's 55% margins, which it's been lately, and you say it's 12.5%, then you're looking at 6.5%, which is reasonable. But I think you're probably looking at a little less. I think you're probably looking at 50% margins and maybe 10%. So again, I always like to look at it conservatively. So if I'm looking conservative and I say it's 50% margins and 10% growth, you're looking at a compound return that's less than half of what the market's going to expect. So again, I love the company. I just think it's shot ahead of its skis. It's gained so much so quickly that I think that it's better that my capital be spent elsewhere. And that's what you got to understand. It's not always about, something can be a great investment, but if you have if something said, oh, this is going to return 12%, that's great. I would take that any day. But if someone else showed another one that's an even better return that could make 20% with less risk, then why not take that? I would sell the great return for the amazing return any day. So I still think Prologis is a great company. I just think it's very expensive now. If you can see in the last 6 months, it's up over 25%. And in just the last 20 days, it's up 15%. So great company, but on average, it was going up, over a full year, 30% that year. This year, not much. But in the last year, it's gone up a lot, 40%. So I just think my money can be spent better elsewhere. So those are my quick thoughts on Prologis. Again, my name has been Josh Lipton, and thanks for listening.